Hey everyone, and welcome back to the Investing Iguana. I'm Iggy, and if you've been following Singapore's REIT market lately, you've probably seen the headlines about Capitaland Ascendas REIT's latest results. DPU down 0.6%, revenue declined 2%, occupancy softened. But here's the thing, the market is completely missing the real story behind these numbers. I'm ranked 8th in the 2024 Influential Tigers by Tiger Brokers. We just crossed the 1 million mark for number of reads and 58,000 likes. I've produced over 1,000 videos with more than 600,000 watch hours as of August 2025. I also focus on regional and global economic trends. Today, we're doing a crucial deep dive into CLAR's 1H 2025 financial results. Stick around to see what it really means for your portfolio. We're going slide by slide through their entire presentation deck. We'll break down the key highlights, dissect the financial performance, analyze their massive Singapore acquisitions, examine their rock-solid balance sheet, and figure out what this all means for your investment strategy. Trust me, by the end of this video, you'll understand why smart money might be positioning differently than the headlines suggest. Let's dive straight into slide 1, key highlights. This is your dashboard view of CLAR's performance. Distributable income hits $331.1 million, up 0.1% year over year. Now that might seem modest, but in this economic environment, stability is actually impressive. The DPU came in at 7.477 cents, down 0.6% from last year. Portfolio occupancy sits at 91.8%, while rental reversions, this is crucial, came in at positive 9.5%. Their leverage remains healthy at 37.4%, with a stable 3.7% cost of debt. Here's what most investors miss. That DPU decline isn't operational weakness. It's dilution from strategic capital raising. They issued new units to fund acquisitions. When you're buying assets that yield higher than your cost of capital, temporary DPU dilution can actually be value accretive long term. Moving to slide 2, financial performance comparison. This slide tells the real story. Gross revenue declined 2% to $754.8 million, but look at the reasons. They divested Welwyn Garden City in the UK, 3 Australian logistics properties, and Parkside in Portland. These were strategic disposals at premiums to book value. Meanwhile, they acquired DHL Indianapolis Logistics Center, adding quality exposure. Net property income dropped 0.9% to $523.4 million, but here's the key insight for Singapore investors. This corresponds directly with the revenue change. Their operating efficiency remained intact. The distributable income actually grew 0.1% despite the asset churn. That's impressive capital allocation. Now let's look at slide 3, distribution details. Ex-div date is August 11th. Record date, August 12th. Payment date, September 4th. The period from June 6th to 30th pays 0.998 cents per unit. For income-focused Singapore investors, especially those using CPF or SRS funds, these dates matter for your cash flow planning. What's interesting is the composition. 0.905 cents taxable distribution and 0.093 cents capital distribution. That capital component can be tax efficient for certain investor categories in Singapore. Slide 4 is where things get really interesting. Investment management. They completed a $153.4 million acquisition of DHL Indianapolis Logistics Center. But the big story is the $724.6 million of announced Singapore acquisitions. 9 Tai Seng Drive for $463.6 million. That's a carrier-neutral Tier 3 data center with a 7.2% initial NPI yield. 5 Science Park Drive for $261.0 million in the life sciences cluster with a 6.1% yield. These aren't just yield plays. 9 Tai Seng's current rents are about 30% below market colocation rates. When those leases renew, there's significant upside. 5 Science Park Drive has Shopee as anchor tenant with only 1.5 years WALE. Near-term rental reversion opportunity. For Substack subscribers wanting the detailed financial models, valuation comparisons, and extended analysis of these acquisitions, including how they compare to other industrial REITs on SGX, make sure to check out our premium post. The link is right in the description. Let's examine slide 5, capital management. This is where CLAR really shines. Aggregate leverage at 37.4% gives them $4.5 billion of headroom to the 50% MAS limit. Their debt maturity profile is beautifully laddered through 2034. Only $235 million needs refinancing in 2025. Here's the risk management part Singapore investors should love. 76% of borrowings are fixed rate with 3.7 years average term. A 50 basis point rate increase only impacts DPU by 0.19 cents. Compare that to more leveraged REITs that could see 0.5 plus cents impact. That's defensive quality in an uncertain rate environment. Slide 6 shows their portfolio breakdown. Singapore anchors at 65% with $11 billion. Australia contributes 13%, US 12%, UK Europe 10%. This isn't random diversification, it's strategic positioning across different economic cycles. When Singapore faces trade headwinds, Australia's domestic logistics can compensate. When US logistics softens, UK data centers stay resilient. The sector mix is equally strategic. Business space and life sciences at 45%, industrial and data centers 29%, logistics 26%. They're positioned in tomorrow's growth sectors: AI infrastructure, biomedical innovation, e-commerce fulfillment. Moving to slide 7, occupancy by geography. Singapore sits at 91.2%, down from 91.6% quarterly, but that's just 2 single-tenant departures. Australia recovered strongly to 93.1% from 89.2%. UK Europe leads at 98.9%. The US portfolio at 87.3% shows some softness, but this creates rental reversion opportunities when markets recover. For Singapore investors, remember our industrial occupancy average is around 89%. CLAR's 91.2% is above market performance. Slide 8 reveals the income sustainability story, rental reversions, and lease expiry profile. That positive 9.5% rental reversion in 1H 2025 demonstrates real pricing power. Only 8.9% of rental income expires in 2025. Minimal near-term risk. The portfolio WALE of 3.7 years provides stability while enabling regular rent increases. This lease profile is actually perfect for Singapore's supply-constrained industrial market. New supply is only 5.5% of existing stock over 5 years, and 81% is pre-committed. That supports rental growth. Slide 9 covers market outlook across their key geographies. Global growth of 2.8% provides modest support. Singapore's 0 to 2% GDP range reflects trade uncertainties, but their industrial properties benefit from government support for manufacturing and data centers. U.S. growth at 1.8% supports logistics demand. Australia's 1.6% backs commodity-linked industrial activity. The key insight: CLAR's geographic diversification anticipates these different growth trajectories. They're not betting on one economy. Finally, slide 10, ESG and sustainability. This isn't just feel-good stuff. It's creating real economic value. 80% of properties are green certified. They have $2.6 billion in green financing at potentially lower rates. 27 Singapore properties have solar installations generating 26.4 GWh annually. Green buildings command rental premiums and attract higher quality tenants. As ESG requirements tighten globally, this provides competitive advantages not reflected in current valuations. So here's my overall assessment based on this comprehensive slide analysis. CLAR isn't a screaming buy, but it's definitely not a sell either. This is a quality REIT trading at reasonable valuations with multiple catalysts for gradual outperformance. The bull case is compelling. Singapore-anchored portfolio with government support, strategic exposure to data centers and life sciences, conservative 37.4% leverage with acquisition firepower, recent Singapore deals offering rental upside, geographic diversification, providing natural hedging, and ESG leadership creating competitive moats. The challenges are real but manageable. DPU growth constrained by recent dilution, U.S. trade uncertainties potentially pressuring demand, interest rate sensitivity on floating debt, and modest near-term rental growth in a softer environment. My verdict: hold with selective accumulation on weakness. I'd rate this a 7-10 investment. The 5.1% dividend yield provides income while you wait for catalysts. If you're building a position, consider accumulating below $2.65, especially if broader REIT sentiment deteriorates. For income-focused investors, CLAR's defensive characteristics make it a core holding. For growth-oriented investors, consider it as a base position while supplementing with higher growth REITs. The 12% upside to analyst targets provides reasonable appreciation potential. So we've dissected CLAR's 1H 2025 results, and I've given you my personal take on what it means for your investments. If you found this video helpful and want to seriously level up your investing game, please give it a like, share it with your friends, and subscribe to the Investing Iguana channel so you don't miss our next insights. And for those who want to be truly ahead, our premium members gain exclusive early access to all our videos, often a full week before anyone else sees them. This means you get Iggy's detailed analyses and urgent insights on major market moves directly to your inbox, giving you a significant head start. It's just $1 a month, less than a cup of coffee. Think of it as your consistent daily dose of financial fuel for smarter decisions.